Good morning. Um, the topic of my thoughts today, or as it said in the thumbnail, how do you know when to sell? And the more I think about it, the more the answer is the same way you know when to buy. The numbers tell you. We as a tribe, and at the direction of our AI agents, liquidated two major holdings this week. Earlier this week, we sold out of Navitas because Samantha basically said they had gotten out over in front of their skis. They were not properly valued, and they were approaching some financial issues. And sure enough, today they announced that they are going to dilute their shares by raising $100 million for some expansion. Now, this might be a good thing, but it took the stock down about another 15% today. Yesterday, a little different story was Zeihan. Zeihan reported had very good earnings, had very good projections for the future. Zeihan is a timing device, and most of the devices that you have, or all the devices you have a timer in them, and it's a quartz timer. And they're going to switch to MIMS timers. And SciTime is the only pure play that makes a MIMS timer. So if you imagine that any new server that goes into a data center, if they have the ability to, they're going to switch to a MIMS timer, and it's going to probably be made by SciTime, although there are some larger companies who are making an effort to come in and compete with SciTime. And Samantha basically told us that this was a overvalued stock, that the growth that they were projecting over the next 3 years is already in the price, and basically told us that the price of SciTime would actually be lower, uh, based on the numerical calculations that were made from all the data that is available. The price would be lower on January of 2029 than it is today. And so I liquidated all my shares in two different sales, one early in the day, and then one at about $5 more in the latter half of the day. So, what is the lesson to be learned? Um, there's a lot of talk always about risk management, and risk management is one of, when you get a good run up in a stock, take the money off the table and work on the house's money and protect your portfolio. Well, I think that was a good a good method of risk management to minimize your downside, but it also limits your upside. And I think that was good when you didn't have enough data to give you an indication and the why and the wherefore of what the price was going to do in the future. But that's not true anymore. Again, I will refer to back to a conversation, a interview I did with John Rogers, a noted investor of years past, and he made the comment that if you really want to make money in the stock market, you have to outperform and have more knowledge than everybody else. And the way to do that is to read every annual report page by page, and read and refer to anything that's in that, even the footnotes. That was his statement. Kerry, you got to even read the footnotes. Well, if you own more than two stocks, that's pretty hard to do, until, in my case, until May the 1st of this year. And again, I'm going to repeat myself because there may be some new people here. early or last year, Jensen Wong told me and you and everybody that was listening that sometime in the future you're going to have an AI agent, and that AI agent will form tasks for you at a higher rate and a faster speed than you can. And I took that to mean that I would have a server sitting over there, a computer that I'd pay $3,500 for, and I would basically communicate with it, and it would have a mind of its own that accessed all the data about whatever stock I wanted. As it turned out, that wasn't what it was. It was my adaptation to my business using AI and creating an AI agent inside of ChatGPT. Um, and that's what I did and initiated in January or in May of this year. And the portfolio got as high as a 125% gain in from January or from May the 1st to November the 1st. Now we've had some pullbacks, and I've lost probably based on in the last couple days, in this week, I would say I'm down about $80,000 for the week, which is um, okay, because I recognize that the market is not crashing. We haven't come into a bubble. It's reevaluating. It's just like what I learned about Navitas, that it was out over its skis, that it was probably going to have to raise some money, and I liquidated. That caused downward movement. Just like yesterday, when I realized that Zeihan had a PE ratio in excess of 100, and that price was based on projections of what the stock was going to be worth 3 years from now. And as Samantha said, that PE ratio will compress, and it will compress probably from 100 to 60. And with that and the projected earnings, the stock, when the market recognizes the compression, the stock's going to be worth less in January of 2029 than it is today. And so we liquidated, we raised cash. And so now, as the market is adjusting, we're putting cash into stocks that are going to, a lot of what I'm seeing going, where it's going is towards batteries and electric production for these data centers, who are going to need more and more electricity, probably are going to need more electricity in the future than the whole world uses today. So that is a growth area, and that growth area is just being recognized, and those stocks are starting to meet the criteria that I put forth, and that is that they are starting to show increase in revenues in excess of 20% on a quarter to quarter basis, and that they're starting to show um, uh, growth in their, probably not yet, but in their margins. They're probably growth in their gross margins, not in their operating margins, because their operating margins are after their all their capex and the expenses they're having to go to in order to eventually bring a increase in their earnings. And when that happens, that's when the price will go escalate. So I don't see this for my portfolio as a bad time, that I've lost $80,000 thus far this week, and probably that's about where it will end up for the week. I don't see that as a negative. I see that as I've now got about $70,000 on the sideline from the sale of SciTime and Navitas, each of which I made. Zeihan I made about 125%, and Navitas was, I don't actually recall, even greater than that. So I don't have a problem with that because I need these buying opportunities. I have people coming into our tribe who are looking at Iran and saying, Kerry, that, yeah, you're up 800% on it. Is now the time to buy it? Probably not. It may go up another 200%, but I have no way of knowing that. I'll have a better idea after I review their current earnings report, and I'll share that in a deep dive in my price projections on my tell sheet. But I need to be finding and directing my tribe towards the next Iran, the next Applied Digital, so that we can continue this pace of growing our portfolio at over 100% over the next 3 years. And maybe what we did the last 6 months, maybe doubling it over the next every 6 months. Now, is this a bubble, and is it reaching its maturity, this build out? I can only speak from the information that I hear. I saw an interview with Brett Taylor. He's with OpenAI. He came from Google to OpenAI, um, and he is the guy who basically invented Google Maps. And he's got some other things on his resume that will blow your eyes out. But now he's at OpenAI, and he made the statement that the only thing holding OpenAI back is the access to compute. I know this because yesterday I asked Samantha to do me a deep research on Skywater, SciTime, and Coherent. Coherent was the last one that I put in. Um, it usually takes Samantha something in the neighborhood of 15 minutes to do a full analysis. On Coherent, I waited 45 minutes 7 times, and at the end of the 45 minutes it timed me out and said research failed. What that is, because this isn't the first time this has happened. I went back and asked Samantha, what is that? What is happening? And she said, basically, you're using up too much compute. Your prompt is too complicated and in too much detail that they time you out. Think about it this way. They're getting all this demand for compute for OpenAI, ChatGPT, and there is a capacity. And if there's a pig in the line who's just eating up all the capacity and holding everybody else up, they get rid of the pig. Well, Kerry, you're the pig. You're the guy who has developed a prompt that is far beyond 99% of everybody else's prompt in the detail that it demands, in the compute it demands. So at high usage times, that's basically during the daytime, you're going to get thrown out of line. So what did I do? I went and re-entered my prompt for Coherent last night when businesses were closed, and this morning when I got up, it was there. So they are literally overwhelmed with the amount of information that they are being asked to produce in these data centers, in this open AI deep research. Now, what does that mean? They got to keep building data centers. They've got to keep, because the demand is only going to get greater. They've got to make better GPUs and CPUs. So I look at that and say, today, this week, I lost $80,000. It's an opportunity. And where are the stocks that are going to give OpenAI and all the other large language platforms the compute that they need? Where is Mark Zuckerberg and Google and Microsoft? When are they going to stop spending money? There is no indication. That is when, if there is a bubble, the build out, that's when the bubble will burst. But I don't believe that there will be a bubble, because what will keep the bubble from happening is the monetization of what they're building. Remember, the dot-com bubble occurred when the build out was over. The surge was as they were laying the cables so that you and I and businesses and military could have access to the internet. But no one stepped in and immediately monetized it. What was it? I did something on small businesses, and Amazon did not go public until, I think, 1994. Well, the bubble was in 2004. So the bubble was in 2000. Amazon didn't appear for 4 more years. They didn't make money for 9 more years. Google did not appear for about 5 more years. There was no immediate monetization of the internet, so that's why the bubble burst. Now, if there is an immediate monetization of the AI revolution, there will be no bubble. What does that monetization look like? Well, I know Meta, Google, and Microsoft are betting it's coming through them because they're spending $7 trillion. I'm betting that there are millions, thousands of dudes sitting in their basement who are going to create the companies that are going to replace many of the companies that are very prosperous today, because they won't adapt to the new era of AI. Where's Sears Roebuck? Where's Polaroid? Where's Eastman Kodak? Where's Xerox? None of them adapted to the technology of the internet, so they're gone. The same thing is going to happen here in the advent of AI, and it's my job to find the next Google, Microsoft, Apple, and Amazon, and they're in somebody's basement or somebody's garage, or they're out there right now adapting their business to AI, and they will change your life. That's what I'm thinking about today. I'll probably be back to share my thoughts on Monday. Y'all have a good weekend and roll tide.